reiterate is JP has been trading for 20 years and I've been trading for 11. It's about to be 11. And one thing I know for sure, without singling out certain people, a lot of you or majority of you actually were traders that came in past, the pandemic, right? We're talking about after the pandemic happened, obviously we had that huge reversal into the upside. And a lot of retail traders, came into the market, and that's you guys. And the crazy thing is, a lot of people actually did not go through the pandemic crash, the 2020 crash, or you could say a bearish market, and then the 2018 and 2019 bearish markets as well. So today, I wanted to focus on trading in a bear market and everything related to bear markets, because what you're going to be facing in a bear market is extremely different compared to a bull market. We have been in a bull market for the past 4 years. Yeah. So, yes, of course, a lot of you guys have been doing successful or not successful, but a lot of you guys have been finding it easy to trade, let's say, zero DTEs or swinging options, day trading options, whether it's weekly or, whatever it is. And for those who've been losing in trading, well, guess what? I'm going to be completely blunt with you. It's going to be even easier to lose money when you go into a bear market. So we've had a lot of signs that we are in a bear market. So that's why I want to bring, or potentially going to be in a bear market soon. So I want to potentially bring this topic to you guys, for you guys to understand and get a view or get an idea of what you could possibly be facing within the next 6 months or a year, right? So before we even get started, I have to put this disclaimer up here. You guys can also check the announcements. I have the disclaimer there as well. We are not financial advisors. Both JP and I are non-professional traders. We're just sharing our opinions, experiences, and our personal research. You can see over here, I talked about all of this is basically my experience that I've traded in the 4 bearish markets that I've traded through, almost 5, and also the research I did during that time and also recently. So none of this is financial advice, and you guys have to go talk to a financial advisor if you want to learn more and get get guidelines, right? So the first thing is a bear market happening now or soon? Well, the reality is it's always hard to time it. The funny thing is you're always going to see bear traders who will be like, oh, I've been talking about this drop for so long. Well, the reality is you can't time it. It's almost impossible to time it. And for the people who do, the reality is it's lucky. So you have to realize majority of traders cannot perfectly time the top of the market. You just have to have an idea that eventually something might happen soon. But the thing is, as of late, especially the past 3 weeks, I have been observing that there are definitely signs, and even if you saw it earlier, there's definitely signs that hint towards a possible bearish market in the coming future. So obviously, if you guys have seen SPY and QQQ on the 2-hour, 4-hour, daily, weekly, all of these charts look like these ETFs or indexes are running out of steam. What that means is, the bullish sentiment is just not as strong as it used to be. The candles are getting smaller. The wicks are getting bigger. So there's a lot of indecision, and the bulls are not as strong as they used to be. You could even see this in volume as well. There's also multiple instances where huge sell-off orders were filled during the past few weeks. If you guys trade NASDAQ, QQQ, SPY, NVIDIA, if you day traded, if you actually kept an eye on these stocks throughout the day, I know you guys for a fact remember there was few instances where they're out of nowhere in a matter of few seconds, there'll be like a huge sell-off, and then that, the price will just come right back up, and you're just left on the 5-minute chart like a huge wick to the downside. And then everyone's asking like, whoa, what the hell was that, right? And you try to check if there was news, and there was no news. So that's another hint that basically is showing that huge orders of shorts are being filled at that current time. Also, there's other stocks and ETFs that we can look at that also give us a hint of what's possible to come. One of the more popular ones is TLT. TLT tracks the 20-year bond treasuries, I believe, right? And it typically performs well in bearish markets. If we zoom into this small chart over here, and if you guys paid attention to my Twitter, I talked about how I recently bought TLT leaps for January 16, 2026. And I believe I got the 85 calls. And because if you see on TLT's daily chart here, you are seeing it break the daily trend line that it's been trying to get above. And now the next targets, as you can see, are for me 95, which is what I personally want. And the passive one would be, oh my God, that's huge. The passive one would be 92. So these are my two targets for TLT. And as I said before, TLT typically performs better in bearish markets because TLT is considered as a safe haven, right? You also start seeing low beta stocks such as Coca-Cola, Pepsi, PG are performing really well. If you guys don't know what beta means, to keep it very simple, you should research about this, but to keep this very simple, a high beta stock is something like Tesla versus a low beta stock is something like Coca-Cola. The lower the beta, the lesser the moves are going to be. The higher the beta, the more volatile the moves are going to be, right? So you could see here, if I zoom into these charts, you obviously guys know Pepsi contracts are up 800% or close to 800%. Pepsi is a very slow moving stock. It is a low beta, low volatile stock. You see it start gaining a lot of momentum and power. You also see the same thing with Coca-Cola. Coca-Cola beat earnings. It's been pretty bullish since then. You guys remember the time when we took Coca-Cola puts? What happened to us? We got wiped out after I think only 10% profit. And also another stock is PG, Procter & Gamble. Very strong as of late. There was a huge sell-off one day. I think that was like Friday or something last week. And or 2 weeks ago, and it's been rebounding ever since. This is a very strong... by the way, JP, could you stream my stream, please? Because mine's full.
Sure.
Let me know when you do that.
Damn. Why can't I get there? Okay, so I'm going to stream. Your stream.
So my stream is currently full, so you can view my stream also on JP's stream. Can someone at least tell me if you could see it on there, on his stream? You guys can just type in main chat. That would be helpful before I continue. Okay, cool. All right, so you can see here PG. I mean, this was a huge, strong sell-off that we had. And theoretically, PG, if you looked at the daily, 2 hour, 4 hour, whatever time frame, when you looked at it at that point and when that day was closing, you would think this stock was going all the way down to 150, but it didn't. It rebounded pretty significantly. So those are signs as well. Of course, the obvious signs is high beta stocks are not performing well compared to the past previous months. I'm not going to bring up Tesla because everyone knows how Tesla's been going the past months, but stocks who've actually been performing well, 2 months ago, that are actually not doing well, such as Meta, Avgo, and XLK. We can see the charts here. XLK, which tracks the tech stocks in the S&P 500, has lost significant amount of its price in the past 3 days. We see the same thing with Avgo, which, by the way, everyone was so hyped about after it beat earnings. And look at it now. It's literally ever since it beat earnings, it's kind of been stuttering, and now it's kind of breaking down. And in fact, I almost got puts for Avgo today, by the way, but I did not. And Meta, of course, you guys know one of my favorite stocks, the day trade. Unfortunately, I don't day trade anymore because the options are a lot more volatile, and now you're seeing a bigger breakdown on Meta. So the high beta stocks are taking a hit. Now, also another indication, implied volatility is increasing. A way you can look at this is at the VIX, right? If you guys don't know what the VIX is, we'll create a live session on that soon. JP knows it very well, and he could explain it when that time comes. But basically, the VIX, in a very simple way, tracks the volatility across the S&P 500. If you were to just merely take a line and draw this right here, you could see there's a trend line on the VIX, and we're attempting to break out of it. Usually, volatility increases when there are strong selling movements. So back over here, if you guys remember the flash crash we had in August last year, look at the VIX, right? It went all the way up past $65. When the VIX was at $65, the market was tumbling down. And you could see that the VIX currently is trying to break out of the trend line that you could draw over here. The VIX doesn't always perfectly follow technical analysis, but you could get a better idea of how volatility looks. And again, volatility is always lower when a stock or the market is bullish and very strongly bullish, and volatility increases when the stock or the market is bearish. All right. So now that I scared you with all the signals or the possible indications that there's going to be a bear market soon, before I get into why, bear markets are not the end of the world, I do want to talk about the upcoming events. Today we had HIMS and Zoom report earnings. On Wednesday we have one of the biggest earnings till now, which is Nvidia. And of course, the previous times you always kept on talking about how Nvidia is very important for the market and holding it up, but now it's bigger than ever. I talked about 2 months ago when prior Nvidia earnings happened, how it's not good that the market is relying on one stock to keep the stock market healthy. So what does this mean? I'm going to play out two scenarios for you. Let's say Nvidia does beat earnings. Of course, that doesn't mean that the recession or the bear market is just completely gone. It just means it's postponed. So what you might get is you might just get a melt-up phase, right? That means the moves to the upside are not strong, but they're there, and shorts are not really present, but they are going to be ready for when they get the signals to go short. The other scenario is, of course, if Nvidia misses earnings. If Nvidia misses earnings, you are going to get you should theoretically get a very volatile market following that. Now, obviously, as we talked about, volatile markets usually means that you're going to be anticipating a very bearish market. So, as is now diving into why bear markets are not the end of the world. One thing to consider is, regardless of the past recessions, we're in a different time now. This can work in our favor and this can work against against us. So there's going to be new types of reactions and not everything will be the same. This could work against us. This is because too much money is in the market, which means the strength will show or there will be a huge breakdown. What I mean by this is, if you guys probably don't know this, a lot of foreign central banks took the money after the pandemic and invested it heavily into Nvidia and the rest of the stock market. And they didn't go for, lower beta stocks like Coca-Cola, AT&T, Verizon. No, none of those. They went for Nvidia, Meta, Netflix, SPY, QQQ. They are heavily invested a lot of their currency in these ETFs and stocks. So because of that, this works in two ways. Either they cannot risk to lose a significant amount of their investments, so they keep on trying to push cash in to the markets, which will cause the bearish market to not last significantly long, or the foreign central banks are going to be so fearful of their money that they withdraw and they sell, which will cause the bearish market to continue stronger and worse than ever before. The last time we were ever put in a similar scenario was 2007, right? Because you had banks being greedy, and that's exactly what you're seeing now. And if they become fearful and if they stop putting money into the market, we are going to have a very strong reaction to this. So again, it works in our favor and also works against our favor. You guys need to know this. So you would think, and this is the dumbest thing I would ever hear, is it is easy to get rich in a bear market. Just get puts, right? That's your thought process. And if you're a very novice trader, I don't blame you for thinking that. But it is not true. Majority of traders quit trading during a bear market. Here's the funniest thing ever. If you go back and if you look at all the Discord people or the Discord traders you look at, I guarantee you 90% of them did not trade during the pandemic. And I can tell you, since I've been on Discord for 9 years, I've known literally hundreds of people who traded on Discord. One of my businesses on Discord is selling trade idea bots. So the bots you guys see where people post in the servers you're in, they buy the bots from me because I'm the first one who ever made on Discord, and they use it. I know how many traders are on Discord. And I can obviously tell if a person comes to me when I have the best bot out there. If they come to me and they say, hey, I can't renew this, I'm quitting trading, I have a sense of how many people, the quote unquote, traders on Discord got liquidated during the pandemic. A bear market is not easy. It is not true. If a bear market was easy, we would not have the 2007 crash. We would not have the pandemic crash. It is just not easy. And I can tell you for a fact, If a bear market comes, a lot of the traders you see on Discord will be gone after the bear market ends. That is just a complete statement that I can guarantee you. You don't want to be like them. So that's why we're going over all of this. Now, why is it harder to trade in a bear market? There's many factors. So the implied volatility is the biggest reason of why it's going to be harder for you to trade. The reality is, majority of us here, me, you, JP, Tom, Randy, all of you guys, we primarily trade options. Options are going to be affected by implied volatility. If you guys don't know what implied volatility is, we have a video on it. You should go check it out on our YouTube. But to sum it up very, very simply, again, you should learn more about it, but to put it very simply, the implied volatility, as I said before, increases during bear markets. So that is why puts are usually more expensive than calls. And of course, if the market is going down or is in a bearish sentiment, the implied volatility is going to increase, or the IV is going to increase on the options, which, if you guys didn't know, the higher the IV, the more expensive the contracts become. And also, if the cons are higher IV, if the trade goes against you, you're going to be in a lot much more of a hurt compared to a contract with lower IV. All right. So again, you need to learn more about implied volatility. There's a YouTube video on that I made and JP made. Definitely watch that. So volatility increases because of the high level of fear and uncertainty. In a bear market, people don't know what's going on. Whether it's institutions, hedge funds, whales, people are scared with their money. They want to, make sure their money is safe. So as I said before, IV always increases during a bear market. This makes it harder to do the following. This is surprising: swinging puts and day trading puts, and I will get into why later. As I said before, option premiums, which is basically the option prices, are going to increase. This is because this ties into how the volatility and the IV increases during a bear market. IV crushes are more common. We'll get into how in this example scenario later on, but this happens for puts especially, and calls. Again, we'll get into why later. Reaction times are decreased. Increased market manipulation. Again, everything I've listed here, we're going to get into detail later. And timing becomes more important. This is tied to, of course, the reaction times being decreased. This is because movements are slow, and then out of nowhere, movements will become very sudden and rapid, right? So your reaction times are decreased, which means if your reaction time is decreased, your timing on your trades becomes even more important. Now, chasing breakouts and breakdowns are harder, which I know a lot of you guys are guilty for. And hey, if it works out for you right now, great. But, keep in mind, in a bear market, it's going to be significantly harder. And I'll tell you why in a little bit. Also, here's the hard part, which kills a lot of people. Indicators start losing value and are harder to read. Primarily the RSI and the MACD. And we'll get into why later. News and macro events hit even harder, and I'll explain why in a little bit. So over here, I wrote out price action in bear markets, and I just drew an example graph of what you would see in a bear market. You could consider this, let's say, a 5-minute chart, a daily chart, a 15-minute chart, a weekly chart. Well, not a weekly chart, a daily chart. This is what you'll probably see. A lot of people think that bear markets are very rapid, straight shoot down kind of markets. That's not true. If you look at a weekly chart, yes, you will see like, very sharp prices going like this compared to what we're seeing over here. Well, the reality is majority of you guys are not looking at the weekly time frame to swing trades. You're not holding, you guys are all guilty of this. You're not holding trades for more than realistically 1 or 2 days, if not, 5 to 30 minutes. Right? Which is okay. All of us have our different trading styles, but this is how the chart will look like. As you can see, the sell-offs are rapid, but they're usually followed by very strong, short squeezes or short covers, right? So because of this, you're going to actually find yourself in a lot more troubling situations. A lot of things are going to become less predictable. So we're going to go over what things you need to focus on in just a little bit, but I wanted to draw out what a realistic or a example realistic chart of a bearish stock would look like. You're not going to find just a straight shoot down. You're going to find a strong sell-off followed by a strong, a strong bounce. Again, the same thing will repeat. And then here's the thing that also kills a lot of people: the ranging and the chop. If you guys remember all the bearish days we've had in the NASDAQ, because most of you guys trade QQQ, SPY, right? If you guys remember those days, the days that killed you the most were not the bullish days. It was always the bearish days. And why? Because this is how the bearish charts always looked. The bearish charts were always sharp sell-offs, followed by a strong bounce, which would make you think that, hey, we're going to reverse here, and then it'll continue to the downside. And then again, you would get the false hope that we're going to get calls. And then it goes to downside. And then you're thinking, okay, all right, you know what? I'm not going to get calls. I'm going to get shorts or puts. And then you're stuck in this range. And then if you're in 0 DTE options, you're obviously going to exit with the loss because the theta is going to crunch you up. And if you're in shorts, you're going to start thinking, okay, all right, this is going to break up. You're going to exit your trade and then you get a new low. And then when you start going short again, you're going to get a new high. And then so on and so forth. So this is what a bearish chart looks like during a bearish market. All right. So you could go validate this for yourself after the live session. You could go check, is Kevin bullshitting or is Kevin telling the truth? You'll see I'm right. So drops are very sharp, but it's often met with aggressive bounces. This is why I said earlier that chasing breakouts or breakdowns are very hard, because even though you might get a breakdown and you might chase it, your percentage of profit that you get is usually not that great. So either two scenarios will happen. You will either get a very small percentage that you won't expect and you want more and you don't exit your trade and eventually that trade goes against you, or the trade actually goes your way, but the bounce that follows afterwards is so strong and sudden and significant that you're not able to trim on time. That has happened many times to me when I first started trading and when I went through the 2018, 2019 bear market. That happened to me a lot of times. And I know for a fact that happened to a lot of the traders that post on Discord during the pandemic crash. And where are they now? They're probably in their mom's basement. So something to keep an eye on, right? Reaction time is shortened because bounces and rejections happen quickly, as you can see in this chart over here. And again, you could go validate this for yourself during the pandemic crash that we had. Regardless of this, there's still a lot of chop and range trading. This is why I drew these two examples over here. You're not just going to get bounces, drops, bounces, drops, bounces, drops. You're going to get bounces, drops, bounces, drops, and then you're going to get a range, and then you're going to get a drop, and then you're going to get a range, and then some chop, so it's not just black and white. There's going to be a mix of everything. In a bull market, right, I'll just draw what you would see on a bull market. Bull markets are very easy to trade, and I'll tell you why. A bull market, you would have a push up, push down, right? Push up, push down, push up, push down. Okay, yeah, there might be a little trend, a range, but it's usually a range that you can trade. It's a range that you could look at and be like, okay, all right, it's just ranging to accumulate buyers, and you can find a lot more upside to it. A bear market does not give you that. So that's very important things you would want to keep an eye on. All right, moving on. So swinging and day trading, I talked about how swinging and day trading puts especially are going to be hard. So I'm going to go over why. Since IV is high, timing is very crucial for option trades, as I said before. Option prices are higher, which increases the risk. Why does it increase risk? Obviously, if you have a small account, the bear market is going to be extremely hard for you to trade because the contracts are going to be pricier, both on the call and the put side, which means if you're a small account, you would have to put up a lot more capital or a lot more of your portfolio to enter a trade. And even if you have a bigger account, you're going to have less ability to trim out of your position because you would have to get expensive contracts compared to what you're used to right now. Breakdowns and breakouts have less success. We talked about that before. Theta is a bigger factor due to I don't know what the hell this is, but theta is a bigger factor due to chop and range. As I said, the bear markets always consist a lot of range and chop, and this is always at unexpected times. That's why it sucks compared to bull markets, because the chop and the range is usually followed after it hits a level, right? Let's say you're looking at NASDAQ, for example. In a bull market, if you hit a resistance, yeah, of course, there's going to be some range and there's going to be some chop. But the thing that sucks about bear markets is you'll get chop and range out of nowhere. That's what sucks. So theta, if you're using trading 0 DTEs, are going to be much more, much more impacted by theta, because there's going to be possibilities that you're going to be stuck in chop. And obviously, if you guys don't know, in the end, all the contracts on the option chain that are out of the money have to go to zero value or close to zero value. So what does that mean? If the contracts are more expensive, don't you think the theta will be much more higher compared to the contracts being cheaper? So it really hurts there. So these are going to be there's also going to be a lot of false bear flags to cause short squeezes and breakdowns. That's a huge thing. People think that you're going to get a lot of false bull flags. That's not true. You get a lot more false bear flags. And the reason, wait, do I talk about the reason now? Oh no, I talk about the reason later. Sorry about that. So a common put scenario. I'll talk about this, why you get a lot more false bear flags than bull flags. But here's a common put scenario. Let's say you would take a put as a swing. And again, you could take this whole scenario I'm putting out for you, and you can think of it as a day trade as well if you don't swing. So you take a put as a swing because of an H pattern. Let's say you take it near the end of the day like me, right? If you guys took the AMD trade with me, I posted my chart. You saw that I was looking at the H pattern on, I think, the 30-minute or the 2-hour, 4-hour, one of those time frames. So let's just say you take the same trade during a bear market. The next day, before the market opens, you see that the stock is down negative 1%, which is great, right? 5 seconds before open, the trade's going your way, the stock is down 1%. Well, what happens? Well, once the stock market opens, even though the stock was 1% down, what you'll see majority of the times is the opening price action is followed by a strong short squeeze. And this is what actually used to happen to Tesla a lot. This is why Tesla used to be hard to swing for people who were short or buying puts on it. Because even if Tesla gapped down, it would be gapped down all the way to like 1.6 or 1.7%. The second the market opens, you will see massive short squeezes to the upside. And since Tesla is a very volatile and high IV stock, those puts that you got are going to be killed. So taking this scenario, for example, let's say we get into that put, and next day it opens out negative 1%, but then you get huge short squeeze candles. Those contracts are going to lose immense amount of value. Why? Because again, those contracts are going to be having high IV, and the theta is going to be working against it even more. So depending on the strike expiration and the IV of your contract will actually be a break even or a big loss. And that is so huge. People don't realize that. That's why people get the misconception that you can get easily rich in the crash because you could buy puts. Well, that's just not the case. Because if you actually go and look at all the times, stocks such as, let's say, Microsoft gapped down during the pandemic crash. Yes, of course, some days it would gap down and it would continue down, of course. But there are a lot of days where it gapped down, would short squeeze into the upside to such a point where a lot of people who were short, whether, shares or actual options, they would get stopped out or they would exit the trade because they're down so much. And then the price would then continue to a downside. So that's a huge thing you have to realize. Puts are going to be much harder to trade. You can take this exact scenario and apply it to a day trade. Let's say you get into a put, you see a bear flag, bear flag starts working your way. If you remember the chart I had above over there, I'm not going to scroll all the way up, but if you remember the chart, it starts going your way, and let's say you don't have a trim or a limit order set, let's say 30%, and then absolutely out of nowhere, you get a bounce, you get a short squeeze or a short cover. That 30% will literally, in a matter of seconds, go back to being break even, or if not a loss. So you have to keep that in mind. So now the indicators losing value, right? I talked about that before. Common indicators like the RSI and MACD especially lose value due to chop and range, and also because of false oversold signals. So what you see is, for example, if the RSI is in oversold territory, you might think, it's creating divergence here. It's gonna rebound, and yes, sometimes it will, but it's gonna be much harder to time it. And then because it's much harder to time it, if you get into a position beforehand, especially if you're in options, your contract is going to be decaying in value because you're waiting for it to rebound. And then once it finally rebounds, yes, it might go your way, but you have to also realize then your contract is to go all the way back to break even. which is going to be hard. So indicators like the RSI and MACD lose value. So what are indicators that don't lose so much value? Well, the moving averages and the VWAP, right? So we actually had a live session about moving averages last week, narrated by JP. He did a really good job. You guys should watch it on our YouTube. These indicators actually hold their value a lot better compared to RSI and MACD. Reason is because those are, of course, all indicators are lagging, but those require like crosses and stuff like that. And if you are, of course, if you are looking at the smaller time frames, yes, you will lose. You will be in a very hard spot because smaller time frames will have a lot of indecision and chop in it. But if you look at the bigger time frames, moving averages could give a little bit more value than, let's say, the RSI and MACD. Not saying that the RSI and MACD will be just unusable, but it's going to be a lot harder to use. So if you're going to continue using that, you want to make sure the plan or strategy you have around it is also bear market proof. So how's the way you do that? You go back to the the pandemic crash, and you go back test and you look at all the things that happened and how things reacted, right? So news and economic events, this is what I talked about earlier, right? So these hit harder because of the amount of risk and uncertainty. What I mean by that is, let's say a week ago, right? No, let's say 2 weeks ago, when we were technically still in a bull market. If, for example, if Trump came out and said, hey, I have diabetes, yes, of course, the market might react bearish or it might drop down. But let's say if he said that during a bear market, it's going to be a lot significant. It's going to be a lot stronger, right? Whether it's a push down or a push up. So the uncertainty, because of that, all this news and the fear that's involved, just it acts very violently, right? So you have to keep that in mind. And not only in economic events, but also even earnings. Let's say during a bear market, what do you think is the number one stock people will be looking at earnings for? The same stock they're looking at today, Nvidia, because everyone will be looking and trying to figure out, hey, will Nvidia finally pull the market back up? And let's say Nvidia misses again during a bear market. What do you think is going to happen? You think the market's going to stand still? No, it's going to be going down, So keep that in mind. Another, of course, if you want to put the jokes aside, one huge thing that's going to be impacting the bearish markets is Trump news regarding tariffs. How's he going to do tariffs? How's the foreign affairs in terms of wars going on in Israel, Palestine, Ukraine, Russia? How is that going to impact stuff? What is China going to do, right? So these things are going to hold a lot of significant weight compared to the bullish markets. So that's where swinging becomes even a lot harder. Market manipulation, I listed that as one of the things as why it's harder to trade. So the reason, this is a surprising thing. So short-lived aggressive short squeezes are more common during a bear market. You would think it's the opposite way. You would think that would be the case in a bull market. Well, that's completely false. You will actually find a lot more short squeezes in a bear market. So you might be thinking, that means I just should go for calls. Well, again, you're still trying to find the bottom, quote unquote. It's going to be a lot harder because then you're fighting against a trend. So why are these short squeezes a thing? This is because hedge funds, institutions, whales, whoever you want to look at, make more profit off of short squeezes than downtrends, right? As I said before, the downtrends are just going to be slow, and even when they're rapid, they're a lot harder to manage compared to a short squeeze. And obviously, the guys with a lot more money, whether it's hedge funds, institutions, or whales, they have access to hidden orders, level 2s, level 3s. They're in communication with each other. They have news that we don't know. So because of that, these short squeezes benefit them. So there's going to be a lot of scenarios where you'll find short squeezes that will kill your puts if you're in puts. So again, short squeezes are more dominant in a bear market compared to a bull market. I bet half of you guys did not know that. So again, this works for them because this works for them because traders in shorts panic easier when seeing bullish reversals. Obviously, let's talk about when you guys were in a bull market. If you guys are in a short, you're used to the stock market going up, or let's say NASDAQ. If you're in puts or shorts, If you start seeing that there's going to be a reversal, your first thing that you get in your head is, oh, great, it's gonna bounce up pretty hard, because the bounces were pretty strong. So you would easily exit. So imagine you're in the bear market where you have even more emotion, more fear, and more hesitation in your trade. How easily it is for you to actually exit a trade before you actually see what's going on. So because of this, short squeezes are much more stronger, because people are easily more likely to exit their trade if they're short or if they're in puts. All right. So bear markets are hard, but not impossible. I know I made it seem like it's a very hard, impossible environment to trade. Realistically, yes, it is very hard. I'm not going to lie to you. Unfortunately, the reason why I'm having this live session is because I know for a fact a lot of the people who are on this call are not going to be trading a year or two from now. And the reason, unfortunately, is because, they don't put the time into it. They don't learn, they don't observe things, and, they're irresponsible. So what I'm going to do is I'm going to talk about how I personally, traded during a bear market, during the pandemic, during 2020, during 2019 and 2018. And I'll show you what I did exactly. And again, it's nothing like big brain move or big baller move. In fact, the biggest thing you can do for yourself during a bear market is to stop thinking big brain. Just stop. Just go with what's in front of you. Be simple. Do what's there. Do what's practical. Do what's logical. And stop trying to figure out what's the next big thing. Figure out how you could preserve your capital, because, God, that's what you need. It's not a bull market. You're not going to be saved the next day by a random pop. You're just not. So what have I done in the past? We have talked about credit spreads. I don't care if you find it boring. The fact is, credit spreads are extremely efficient during bear markets. Why? Because of all the reasons why I listed why it's harder to trade in a bear market. What was it? It was implied volatility and theta. So if let's say you're short on let's say Avgo. If you buy a put, let's say right at let's just say you buy a put on a bearish formation, right? Yes, you could end up profitable 2 days down the line, 3 days down the line, absolutely. But any bounces that happen during that time span will significantly take away the value of those contracts. So instead, why not trade in a way where you will actually benefit off of that, where you'll actually benefit off of IV crushes and theta decay, which would be credit spreads. We've talked about credit spreads. I talked about how I highly advocate for them personally in my trading experience. Again, we're not financial advisors. And if you want to figure out if you want to figure out how to trade credit spreads, again, I talked about the basics in a prior video. I think it's very important, even if you don't want to listen to my monotone voice, it's very important to figure out what credit spreads are and really consider possibly trading them during a bear market, because that's one of the biggest ways I actually preserved my capital, and I actually grew my accounts, not significantly as I did in the bull market, but I did grow my accounts during a bear market. But I didn't grow it as rapidly, but I grew it in a very safe way. Credit spreads was a huge deciding factor for that. So another thing, swing trades will become less of a go-to compared to day trades. As you guys know, since most of you guys follow me here, you guys have seen that the past 6 months I've been primarily trading swing trades. The reason is because in bull markets, swing trades, you would get a lot more money compared to day trades, right? That's just realistically a fact. Think about this. Why haven't my swings been working as efficiently as they have been working the past 3 weeks? You think it's because I'm reading stuff wrong? Not really. That's not my ego talking. That's just a fact. I mean, I'm not looking at wrong setups, except the TLT one. The TLT one is wrong. But it's not because I'm looking at wrong setups. It's because when you're in a bear market, a lot of the setups you see are just not going to work. They just don't work. It's just how it goes. There's sometimes there's either news, right? For example, Starbucks today, perfect put setup. That is literally an indication of what a bear market will be. Starbucks had a perfect put setup, but guess what? You got news for Starbucks overnight or today. I forgot which one it was. I'm pretty sure it was today morning before market open, where Starbucks laid off 11,000 employees. And I didn't know that, by the way. I did not know that. JP was the one who told me that. And I figured that like halfway through market open. And because of that, you had the employee layoffs, and that was bullish for Starbucks because, as JP explained it, that's where you would see the company making more revenue because they have to pay less expenses. So because of that, a completely good bearish setup got invalidated. That's exactly what's going to happen to a lot of the put setups that you try to swing. It's not going to happen to all of them, but it's going to happen to some of them. So it's something to consider, right? So if you, in my experience, when I day traded more during a bear market, I had a lot more success because I had more control. And I'll talk about sizing and frequency of trades in just a bit. But day trading, I found a lot more success in bear market because you have volatility, right? So if you get the move right, and if you get the entry of the trade right, you're going to find your trade profiting pretty decently. But you have to make sure you kind of hone in into how you're going to figure out those entry points. This is what ties into the next point, which is, and I haven't read because it's pretty important. Stop being lazy. Even though you guys are here, it's not enough. It doesn't matter if you're here in a free live session. You need to educate yourself and learn more. Now, this doesn't mean you're going to try to figure out what the new ICT 2026 model is. No, not at all. This means you want to learn about market fundamentals. This means you want to learn about how the market moves, what makes the market moves, different sectors. Sectors are going to be so important when a bear market comes because money is going to be constantly rotating from one sector to another. You're going to see, for example, if you looked at the heat chart today, a heat map, and I'll show in just a little bit. If you looked at the heat map today, you're going to see that tech lost a lot of its value. A lot of the stocks in tech were down, but what were the sectors that were green? Consumer staples, healthcare, telecommunications. So sector rotations, learning your sectors are very important. I cannot stress that enough because you want to be in the sectors that are growing. You want to be in the sectors that are not getting hit hard by a bearish market. I talked about earlier about low beta stocks. The reason why those are working really well is because during a bear market, it doesn't mean they're going to be reaching all-time highs, but they're going to be moving a lot better and a lot less unpredictable compared to higher beta stocks like Nvidia, QQQ, SPY. Like, this is just a reality. You can't just keep on expecting to trade the current way you trade in a bear market. And I'm saying this explicitly because 90% of you guys trade 0 DTEs. And that's fine, whatever, right? If you developed a strategy, that's great. But you have to also realize that when a bear market comes, which it most likely will, those things are just not going to work as well as they do now. So you have to you have to expand your horizon. You have to learn how other stocks move. You want to look at stocks that are lower beta, such as Coca-Cola, Pepsi, Kroger's, Walmart, TLT, Verizon, AT&T. The list literally goes on. There's so many stocks out there, and yet you're keeping your vision so narrow. So open your horizon. Backtest and observe. It is so easy to do this, yet I see barely any people doing this. If you want to ask me what my number one reason of success is when it came to trading, is because I backtested and observed. I didn't use any fancy application. All I used was Thinkorswim. Thinkorswim, as I talked about before, has an amazing feature where you're able to literally rewind back in time, view the stock price, and actually view the active option chain. So if you have a Thinkorswim account, you can use the rewind feature. You can go all the way back to the pandemic crash, and you could try to use any strategy you want and try to see how successful it is. You will see ICT was crap. You'll see RSI was crap. You'll see MACD was crap. But you'll see what will work. Price action, volume, moving averages, VWAP. These things worked, and you'll see that if you go back again. You can, if I'm lying, you will see I'm not. You can go and backtest, and you'll see I'm right. And even if you don't have Thinkorswim, and for some reason you don't want to be logical and get a Thinkorswim account, that's fine. That's you. You have TradingView. TradingView has a replay feature. Even though it does not show you the great things Thinkorswim shows, such as the active option chain during that moment in time, you can actually use the backtesting or the replay feature on TradingView, which will allow you to go back in time. And I'm not sure if you need a premium subscription on TradingView for that. But I mean, my thing to you is, hey, if you're trying to trade during a bear market, For me personally, I think having premium on TradingView to have a feature where I could go back and replay certain times and certain periods is very important for me to make sure that my strategy works during a bear market, right? So yeah, sorry, I'm rambling on. So sizing with caution, this is one of the biggest things. Bearish markets are not for you to rapidly grow your account. This is because bearish markets are time for you to preserve your capital and grow slowly and fight inflation. You might be scared to shit because I'm scaring you about what will happen during a bear market and how it's, very hard to trade in a bear market. Yes, that's true. It's very hard. But what is the reason why you would trade in a bear market? Well, you would want to fight inflation, because if you have your money in your perspective could be, if you have your money in your bank account and your savings account, some of that money you could possibly be using to at least grow in a very safe and slow way, right? Nothing is guaranteed. But if you're able to give yourself a chance to possibly grow your account or grow your part of the money that you saved, maybe it could be a great result instead of just saving it throughout the recession. Or maybe it is not a better result. This is something you have to figure out. My financial situation is different than JP's. JP's financial situation is different than Alessandro. Alessandro's situation is different than Tom. And, everyone's situation is different. You have to figure out, can I risk my money during a bear market? And if I'm risking it, why am I risking it? If you figure out the reasons, you will find yourself figuring out plans and trading plans that work for you. So sizing with caution is very important, because as I said before, all the way back, since the IV is very high, you're going to find yourself with contracts that are very expensive. And I'm so sorry to say this, because it pains me to say this, but for those of you who have small accounts, the truth, and I will tell you upfront, is you will most likely might not find yourself trading in a bear market, because the contracts are going to be expensive. If you really want to risk it, I'm telling you from my experience, the only options were really, really low beta stocks. And I'm talking things that move slower, because you would see yourself you not being able to trade bigger accounts or bigger stocks or higher beta stocks, because they have expensive option chains. And then if you get into those trades, you're risking a lot of your portfolio. And I got a question, what's considered a small account? Again, I'm not a financial advisor. In my opinion, what to me a small account is anything below 5,000, predominantly anything below 1,000. So I'm sorry, I'm being realistic with you. If you have an account that's really small, it is just going to be realistically harder to trade. So if you want to trade in that kind of market, again, the risk is up to you, but you have to figure out what you need to do and what you're willing to risk and why you're willing to risk it. So another thing you want to look at how you could possibly go according through a bear market is you need to put a bunch more emphasis on bigger time frames. You're going to see a lot less value in 1 minute and 5 and 2 minute and 3 minute and 5 minute time frames. You're going to see that stuff on the bigger time frames are going to be working a lot more. This, one of the simplest reasons I could say about this is because as a bear market continues, there's going to be less and less retail traders. So because of this, you're going to see less people looking at smaller time frames, and majority of the herd, which are much more bigger guys such as institutions, hedge funds, and whales, looking at bigger time frames. And in a bull market, yes, bigger time frames definitely held a value, but you could also still do very well trading off just a 5 minute and 15 minute. I used to do that all the time during a bull market, worked perfectly fine. But now, since a bear market is possibly coming, you kind of maybe want to get familiar with how bigger time frames are, how you might want to wait for a candle close or maybe not wait for a candle close, figuring out what levels you can look at, what levels are valid, what levels are not valid. Very important to look at bigger time frames. You also want to reduce noise and clutter. This means you want to figure out which levels and indicators to keep. If you're a person who has a lot of levels on your chart, maybe you want to consider not having that many levels. The reason is because you're going to find yourself catching yourself in too many trades. And for those who are high frequency traders now, you're going to be really hurt, most likely, if you keep up that same habit in a bear market. because you're going to find so many false flags. You're going to try to go on every single thing because, as I said, in a bear market, you're going to find a lot of more flags versus a bull market. So you're going to find yourself in a lot of fake trades. And even if you do amazingly well on, let's say, 8 out of 10 trades, I bet you majority of the people in that situation, the 2 trades that they lose will wipe out majority of their profits from their previous trades. And if that's your situation now in a bull market, you best believe it will be significantly worse in a bearish market. So please figure out what you want to do. Maybe it's worth reducing noise and clutter. Again, that means either indicators, levels, all up to you. I'm just telling you my opinions. Being informed on economic events. This is very important. You cannot be, let me rephrase that. It is very hard and very impossible, in my experience, to trade in bear markets without knowing almost everything that's coming up. If you're swinging, you need to really hold importance to the upcoming economic data that's coming out. You need to make sure that if you're getting into a swing trade, it's not going to be impacted by that data. And if the data that's coming out is so important, is it really worth swinging? You have to realize these things. Also, if you're day trading, this also applies to you very much. You need to know when, the redhead is going to speak. You need to know when Trump's going to speak. You need to know when, if there's going to be a Fed speaker or a politician speaking, Jerome Powell. These things are going to be very important. Very important. So if you don't know what economic events are and stuff like that, or upcoming events, and you don't take the time every morning or every night to figure out what's happening that day or the next day, you maybe want to get in the habit of that. And these things are, by the way, I should not hear any complaining. I'm not saying you guys are complaining right now. You guys have been great. But I should not hear any complaining in your minds. Because guess what? You had it much easier than the way I or JP had it. I had it easier than JP. And you guys have literally so much resources available. You guys have ChatGPT. I showed you guys in a previous live session how, even though it's so cheesy, how you can use ChatGPT to figure out if an upcoming economic event will impact the swing you're taking. And based on that, you can figure out if you want to really take that swing or not. You have, if you see, for example, if you tonight after this live session, you're like, hey, I may want to listen to that Indian Kevin to go figure out what economic events are. And you go on to, let's say, Market Watch, because I go on to Market Watch. I think JP uses Financial Juice. You can use any websites. There's a bunch of them. And you see, for example, not saying that this is coming up tomorrow, but you see, for example, PPIs tomorrow. You're like, I have no idea what PPI is. Go on to ChatGPT, take your lazy ass to ChatGPT, search up what is PPI, explain it to me very simply. There you go. You figure out what PPI is. There's maybe 8 or 10 more significant economic events you need to learn. CPI, Fed rate cuts, right? Michigan unit. JP's favorite market sentiment, which is the Michigan sentiment, right? There's so many things you could look up, and it's so easy to learn this. You don't need to go onto YouTube. You just don't. You can literally learn everything in a matter of seconds, and you can learn in such a way that's simple to you. So there should be no complaining, realistically. Sorry if I'm being mean. Reducing frequency of trading. If you're a very high frequency trader, you have to maybe consider toning down a bit, right? Because some days will just not be worth any trading at all. And I know for a fact, if you actually look back at all the days in the past 2 months, well, actually not 2 months, the past month, that have not been worth trading and have been stuck in significant chop, majority of the days were bearish. So if those days that you saw that had a majority of chop and range and just consolidation just killed your contracts and had a lot of false flags, imagine that on a much more larger scale and a lot more frequently. So again, if you're used to being a high frequency trader, you might really want to consider that, and you might want to consider quality trades versus just trying to shoot the barrel and just hit a home run eventually. That's all I've written down. Unfortunately, that's why I came on late today, because I put a lot of time into writing this, and I unfortunately didn't have enough time to completely finish it. But that's majority of the things that you would have to possibly look out for in a bear market. And the funny thing is, here's the thing. I still will experience and observe new things in a possible bear market that's coming up, because as I said before, the reason why I said this live session is so important is because we're in a very different market than where we were even 4 years ago. 4 years ago, yes, there was a lot of money in the market, but why are you guys all here today? Majority of you guys are here today because you heard, hey, people are making money after a pandemic. The stock market surged up. We're going to all-time highs. That's why you're here. You heard your friends, or you saw on TikTok, you saw on Instagram, you saw somewhere that people are making money. And because of that, there's so much scared and dumb money in the market right now that anything can make the market just go into shambles. And you have to be prepared for that. We are in a place of no return. What's going to happen in the future is unpredictable, but you can look at history and try to figure out what could possibly happen. And one of the greatest things for trading that I've learned, and the reason why I love price action, is because price action it forces you, if you're a good price action trader, it forces you to react instead of initiate. So instead of trying to get behind, before the curve and try to, for lack of better words, front run things, you will actually see, if you just read price action, the reason why it works so well is because you wait for reaction. You wait to react to things that are confirmed for you. And that's just a valuable asset you have to learn, or skill that you have to learn when you're in a bear market like this. I am not going to be flourishing in a bear market. I'm just not. My win rate is significantly high. It is above average, but I will tell you, my win rate will be impacted by a bear market. Right now, it's at 92 or 94% for the whole year. I think unfortunately, because of the past 2 weeks, since we're getting into somewhat of a bear market, it's dropped lower. I think it's now 90%, or a little bit lower than that, 89. In a bear market, a high win rate guy like me, which, by the way, I just don't get small trades. You guys have seen my trades. They go to like 400, 800%. I have an average percent trade of 160, 180, 200% per month. And on a yearly basis, it's even larger than that. So a guy who, like me, who's had tremendous success, will still see their success rate drop, maybe even sometimes to 70%. You'll see my average percent trade dropping from 180 to maybe 100%. Like, it is a huge difference. So if I am if I am been impacted in a less volatile market, imagine how impacted I will be in a very volatile market, because we're in a very volatile market compared to 4 years ago, compared to 6 years ago, and compared to 8 years ago. So that's what I had to say about trading in a bear market. You guys can go ahead and type out your questions in the main chat that is regarding what I went over, or something related to bear markets, and JP and I will answer to the best of our ability. Meanwhile, you guys type it. I wanted to ask you, JP, was there anything you wanted to mention before we get into questions? Or
Bear markets trade in bigger time frames, and you have to have a bigger picture outlook. I've been doing this for too long, and I've traded the most money I ever made was in bear markets, and that's because I played very long dated puts, or I was short the market whenever I had my really big account, the account with the quarter mil. Um, if you guys are trading smaller time frames, you're gonna run into situations where you're just gonna get lost, and you're not gonna be too sure what's going on. I can give a perfect example of something that happened today that that everyone was like, I was never ever long today at any given point. And I can show you why. Um, Today, everyone was trying to catch a bounce on the S&P. And everyone thought that we were probably going to try to break and close above the 50-day moving average over here, if you can see my screen. But I kept saying to everyone on the moving averages, whenever you see a bigger time frame death cross, the market's going to push up and you're going to have these pops. And here's a perfect example. Divergence traders that were trading RSI were thinking that this was going to keep going, but we knew that the moving averages were indicating that the 5200 cross on the 30 was inbound, and no matter what was going on the smaller time frames, that could have indicated that the market was going bullish. You can see here there's an EMA crossover in a smaller time frame. You broke above the 50. The reality is that just by looking at the 30, you could tell that the trend was bearish. So I actually did take puts. I made a nice percentage on SPY puts. That was like my end of day trade. And I just, something that I was doing on my own. But this is when moving averages become your friend, because the trend is your friend in bear markets. You don't try to fight them. You don't try to find reversals. You just go with what is happening, and you go with what's happening on the chart. And as you said, Kevin, the other thing is you don't want to have all these pivot structures. You don't want to have everything, all these unnecessary indicators at that point, because intraday trading becomes irrelevant. You just want to have the major levels and you just want to draw them. And this is the S&P, and I always have the S&P side by side with the VIX. All you got to do is just draw the bigger levels and draw your patterns. And when they start to break, they break and they flush and they flush and they flush hard. So that's all I can say. And if you see a bearish setup and it pops temporarily, okay, it's not a big deal. But if the trend is still bearish, just bear with it. If you guys don't like trading put setups, then you can actually trade the VIX and you can go long. I mean, there was a beautiful setup on the VIX towards the end of the day where it bounced right off this pivot structure. Bounced off 17 and it popped all the way to 19. You could have taken the $20 calls, the 20 calls on the VIX at any point today, at any strike, at any for any date, and you would be up. Yeah, they would have been inflated because the premiums would have been up. But if you don't like playing put setups, there are call setups that you can trade that make the market bear. You can be in bullish positions for a bearish market. Same thing goes for example, if you don't want to trade the VIX, you can always trade the UVXY. Here's a perfect example. It's the inverse of SPY, right? So if you're looking for bullish setups on a bear market, you can buy the UVXY. Here's a perfect example of how SMAs work perfectly. Bounced off 20 and rejected the 50. So there's bullish cases for bear markets, if that makes any sense. That's all I have to say. Kevin?
Oh, sorry. I had my mic all the way down. This ties actually into my next point, which I kind of wrote down right now, which I didn't, unfortunately, I didn't get time to right before. You know, realistically, a lot of you guys, since you came into when the market was no longer bearish, you will see a lot of these dips that are always bought up. For example, if you were to look at SPY, a month ago, 2 months ago, even the flash crash, a lot of times SPY and the indexes and the stocks were just bought up, right? If, for example, you were to look at Netflix chart on August 2024, after the flash crash, Netflix rebounded like crazy. It went to all-time highs. Same thing for Meta. That's not going to happen in a bear market. So what's very important to realize is the concept of buying the dip when it relates to day trading, swing trading, and even long term is not necessarily going to be a valid strategy anymore, especially for long term. Because I hate seeing this phrase now, because I'm sick of it, because it's going to mislead people. And again, whole reason why I'm on here is because I hate seeing people lose money, is because I'm gonna keep it civil, these dumb people on Twitter, Discord, keep on saying that things are on sale. They keep on saying AMD's at sale. And yeah, theoretically, if you were to look at fundamentals, yeah, absolutely, it is on sale. But what if there's a bear market? You think you're going to be looking back if AMD's at 103 right now. Let's say you bought, if you listen to those dumbasses and bought AMD at 103, and let's say a year from now, AMD is at $64, or let's say $91, you're not going to be looking back and thinking that was a great purchase. So keep in mind, buying the dip is not going to really work anymore. And if you're really like, if you're like me and you really like trading bull setups, JP said it perfectly. You know, there are still things you can look at to trade bullish setups. You could trade the VIX, you could trade SQQQ. Whoa, wait, SQQQ, which is basically the short Nasdaq, right? Inverse Nasdaq. You can trade UVXY. There's many tickers you could trade, but they do come with risks because they are leveraged. So those are bullish setups. You also have like lower beta stocks, where if you see, this ties into the next thing I wrote over here. If you see a bullish setup on a lower beta stock, you want to make sure it's a strong one. You want to make sure it has a curve. What I mean by that is, if you guys have heard me before, I've said numerous amount of times, my favorite setup for bullish setups is the ascending scallop. Not because it sounds similar to fried calamari, but because there's a very big reason of why. This part right here is very crucial. This is what makes the ascending scallop JP, could you stream my screen for just a second?
Oh, sorry, my bad.
Yeah, no worries. What makes the just let you, yeah. So what makes the I'll give you a sec.
Can you see it?
No. Oh, so okay. So you press the box with the right thing, the right to your, yeah. Press that. There you go. Press that. Yeah. No. So the reason why the ascending scallop works so well is because this area is so crucial. Because, by the way, JP, I can't see my screen again.
God damn.
Okay.
I
So
can't even find my mouse.
wait, what?
There it is.
All right. So because this area down here is where the buyers accumulate, and the more buyers you have, the more stronger a setup becomes. So as JP said, in a bearish market, it doesn't mean you can't trade bull setups. You just need a bit more confirmation if you want to be on the safer side of your trade. So you want to see curls. You want to see, like, you know, for example, let's say you have, you know, consolidation, right? You want to see consolidation to the upside. You want to see volume increasing. But one of the main things that I used to love trading in a bear market was ascending scallops. They didn't work all the time, but they gave a higher success rate than just, like, let's say a level bounce. So that's why I love the ascending scallops so much now in a bull market, because it works so well for me in a bearish market. So again, bullish markets are still possible, but you have to consider the stock you're trading. You have to consider the upcoming events if you're swinging, and if you're day trading, you want to consider the volatility and the huge bearish sentiment in the stock market. And you want to see if there is actual strength or accumulation of buyers behind that bullish movement. I'm not going to lie to you. Of course, there's going to be bounces and bullish setups that are not going to have consolidation and will just bounce to the upside. Maybe the caveat to that is you have to be okay with missing out on some trades. You have to think, is that more valuable to you, or would you want to keep risking your money on the table because you want to get into a trade? So, yeah. All right, so that's what I had to say about the bull setups. You can stream whatever you're streaming before, JP. But all right, let me go through some of your questions. So let's see. Someone asked, is scalping better? Again, we're not financial advisors, so I'll tell you my opinion. I don't think so. I think scalping is one of the worst things you could do, because then that ties into the whole high frequency trading thing that I was talking about before. So you are going to find yourself risking a lot more money in a high emotional environment. And in some days, this is the thing, this is the reason why it sucks. And I'll tell you exactly why so many dumb people from Discord who call themselves traders and posted on Discord got liquidated from the market and from Discord, is because these guys only primarily traded QQQ, SPY, IWM. And back then, Apple's really strong, and that was used to be the best weekly option chain to trade. They used to trade these things and Tesla, and they would only trade those. And they used to get into like 5, 10, 15 trades per day. But the thing is, these guys were used to, during a bear market, they would have 2 green days and 3 red days. And then in the next week, they'll have 4 green days, but the 1 red day they have literally wipes out all of their gains from 2 weeks. So scalping, in my experience, has not been a great way to trade during a bear market. You're already in a high risk environment, and when your emotions, even if you're as monotone as me, your emotions are going to be high. You're going to be a lot more cautious. You're going to be a lot more hesitant in the trades you're in. And if you're hesitant now about your trades and you're exiting your trades early, or you're trimming too early, or you're finding yourself where emotions causing trades and stuff like that, you have to be a lot more solid during a bear market. So maybe scalping is not the best option. All right, let's see. What do you think about the Jade Lizards during bear markets? Unfortunately, I don't know too much about the Jade Lizard option strategy. I've heard it's really great. And the great thing is, during bear markets or any complex market, complex trading strategies such as credit spreads, debit spreads, Jade Lizards, iron condors, all of these things are typically more successful compared to buying naked calls and puts. So just buying calls and puts are a lot riskier than complex option strategies. Again, the risk with complex option strategies is a lot of these require capital and then a lot of collateral. But the reason why these work better compared to naked options such as calls and puts is because you usually have something protecting your position, and that position, which is usually a short leg, protects you from IV crushes and theta. So that's why those kind of strategies work pretty well. So does it affect futures contracts the same like it affects options? I don't completely understand your question, but if I were to kind of understand what you're trying to say, I guess you're trying to ask, is futures going to be impacted compared to day trading? I'm not day trading, option trading. Well, yes, but in a different way. So what I mean by this is, okay, it's going to suck hearing, but this is just going to be reality. Option trading, you're going to be affected by theta, IV. We talked about that, right? We didn't really talk about futures. Let me knock it to you here. How are you trading futures? How are you trading futures, bro? I'm pretty sure 80% of you traders are trading futures on a prop firm. Do you think a prop firm is going to be there during a bear market? Probably not. So how are you going to trade futures? And if you're going to be trading futures with your own cash, good kudos to you. No, I'm serious. Kudos to you. But you have to realize how much risk you're putting up on each single trade. So yes, the futures market will be impacted because, again, you're going to find yourself in a lot of false flags, similar to the trades we were talking about before. But then your next question is, will there even be prop firms during a bear market? I'm pretty sure in a bear market where a lot of companies that are bigger caps are struggling to make a profit, prop firms, which literally benefit off of there being more retail traders, are going to find themselves in less and less business, and eventually most of them are going to close out. We have talked about how a lot of prop firms are closing off. A lot of prop firms are applying more rules. They're not applying more rules so they can go, get an ice cream from you and you guys go out on a date because they're so nice. No, it's not because of that. It's because they're losing money and they can't keep up with having big payouts, or they can't keep up because their operational costs are becoming a lot bigger compared to the amount of people who are buying their accounts. So futures trading might not be as accessible as it used to be, as it is right now. So yeah, that question is not related to this topic, so I'll get back to that later. Let's see. I'm going through other questions here. Whoops. Can I make this smaller? All right, there we go. Oh, so you need premium on TradingView? All right, yeah. So that's related to when I was talking about the replay feature. Again, I personally think it's very important to go back in time and look at the things and look at the charts at how prior bear markets were, so you could get an idea and see what really works. I think it's worth it. But again, that's all up to you. So yeah, what is considered a small account? Okay, yeah, I said what a small account is. Every time someone speaks, all market really moves. Yeah, so if it really moves right now with Trump talking about tariffs, Gaza, Israel, Ukraine, Russia, China, Canada. Imagine how it will move in a bearish market where every single country is literally fighting to keep their economy, strong. Keep in mind, if the American economy gets hit, the global economy gets hit. A lot of things are backed up by the US economy and the US stock market, tying back to what we talk about in the central banks. So keep that in mind. Forex, yes, Forex will be heavily impacted by a stock market decline. Very impacted, very volatile. So keep that in mind. So if you're a Forex trader, I'm not saying not to trade it, but you have to keep in mind it's going to be very volatile. Flip charts upside down. I mean, even though bear setups and bull setups work differently, I guess you can, right? This was solid information. What I'm also considering is maybe cutting my trading down and moving more towards building my long-term positions if we indeed see a market downturn. That's possibly a good idea, right? As I said, a bear market doesn't provide the first buying opportunity is maybe not the greatest buying opportunity. But if, for example, you really love a company, let's say you're in love with HIMS. Let's say HIMS still has a strong trajectory into the future. If you find valid places to potentially add shares into your long term, I personally don't see in my experience where there's a downside to that unless you size irresponsibly. Then of course, then you're doing the wrong thing. Then you're not even long-term trading. You're just trying to get a quick buck, right? So you want to make sure if you're going to tone down, okay, let me rephrase that. If I were to tone down my intraday trading or my swing trading or my day trading and put it into more long-term, I want to consider a few factors. I would want to consider safe havens. So silver, TLT, GLD, Coca-Cola, Pepsi, Kroger's, Walmart, Verizon, AT&T. The list goes on. There's so many of them, right? I want to consider those positions. I want to consider companies I really like. Like say I like Apple. I want to consider Apple. I want to consider where Apple will be good to buy around. And also, one thing I forgot to add. Here's the great part. Bear markets are really great when it comes to levels, especially when it comes to long-term investing. So levels are not invalidated during a bear market. You just need to make sure you look at the important levels. So if you think it's impossible to look at levels, no, that's not the case. You can trade with levels. You just have to make sure you find the levels that matter. So that's obviously going to mean, bigger time frames, Fibonacci retracements. Again, we talked about that in a week ago or 2 weeks ago. We have a lot of resources on our YouTube. You should watch it. Or if you don't want to watch or listen to my monotone voice, go on YouTube. Ask ChatGPT. There's so many resources you can learn. So, yeah, this man can literally change everything in just a single. Well, he doesn't tweet anymore as much, so I guess on Truth Social, right? Can we possibly get an example of the pandemic market? Just to see the PA, I can backtest myself. But yeah, sure. After I answer a few more questions, I could definitely go and look at that. What's the time right now, by the way? It's 8:37.
8:37.
Okay. Our word seems more fitting. I guess you're talking about when I talked about the gurus on Twitter and Discord who say to buy the dip and there's a great buying opportunity and everything is on sale. Yeah, the R word is more fitting for them. But that's not towards all companies. I'm not saying everybody who's saying that is wrong. But if people are saying that for certain companies that just don't make sense, might want to look at that. Like if someone's saying that, for example, this is my opinion. If someone's saying that for Google, Meta, if they're saying that for that kind of thing and saying, hey, this is a generational buying opportunity, and let's say they end up wrong and there's no bull market that follows after NVIDIA earnings and there's no small melt-up phase, those are going to be the first setups that are going to die off quicker compared to a setup like, let's say, even Apple. Apple will survive better than, let's say, a setup on Meta and Google. So, yeah. So do you see an H pattern on 30-minute, 1 hour on SPX? I'll check that in a little bit. I bet it's the 30-minute and the 1 hour. You look at bull setups on Q. Yes, so SQQQ, and I'll show this in just a second because I'll pull up my trading view in just a second. But SQQ, if you really want to trade bull setups, similar to what JP said with the VIX, you can see that with SQQQ. And you will actually see the example I'll pull up today. I realized this too late, unfortunately, because somebody brought it up. But I wish I saw it earlier because I would have taken calls on it. Isn't that part of the cup and handle? Bro, the ascending scallop and the descending scallop came before the cup and handle. But yeah, it's similar to a cup and handle. A cup and handle, for example, needs to have prior movement beforehand, and then it comes down like this, and then it breaks out. But what is this? It is an ascending scallop, right? So that's the ascending scallop, and then you get the cup and handle. That's just me being a little douche to you, but yeah. Does FVG work? No. Dude, fair value gaps were never a thing. Alright? Fair value gaps were just two levels brought together on a smaller time frame. And the reason why it quote-unquote worked was because that was a prior thing that worked when you looked at price action and levels. I can't really... I'm going to explain this without getting too deep. FVGs are comprised, basically, the reason why they quote-unquote work nowadays is because of volume footprints. If you don't know volume footprint charts, it basically has to deal with delta. And because of the difference in delta between candlesticks, that area that would create FVGs are the reason why they work. ICT Concepts came out and gave the term FVGs, but there was no prior term to them. It was just a common thing known against for traditional traders, that a difference in delta between multiple candles, especially two candles that create an quote-unquote FVG, that's what made it very important. So FVG is a term. The concept behind an FVG is something that lasted beforehand, which I cannot claim as untrue. But if you're using FVGs, I hate calling it that, but if you use those areas, or if you just look at them on a smaller time frame, like let's say if you have been doing very well with a 5-minute FVG, 15-minute FVG, you might not find as much success trading those during a bear market versus, let's say, and I hate using this term, but 30-minute fair value gap or 1 hour fair value gap. So again, this ties into prior what we said, where the bigger time frames just hold a bigger value compared to everything else. If you've never heard of Jade Lizard, there's so many option strategies out there, you definitely want to learn them. Especially if you're able to have a margin account, maybe it might be worth considering learning all the complex option strategies out there. A really great channel to learn is Tasty Trade or Tasty Works. They're amazing with explaining and bringing up data. So if you want to learn complex option strategies, check out Tasty Trade or Tasty Works on YouTube. How to protect your long-term positions? Do you close them out, sell covered calls, or other strategies? That's a really great question. So long-term positions are tricky, but it's also tied into perspective. If you have good fills, like for example, Tom, he's had great fills on AMD. He doesn't really care if it goes down because he's already trimmed out a majority of his position. And, he's fine if the rest of the position goes red because he's already made profit on a prior position. Let's say you're not in a situation like that. Let's say you've recently started building a long-term account. Let's say you just started building it in the past year. And some of the entries that you have will probably be a lot higher compared to where it would be in a bear market. So let's say if you bought, just giving an example here, Apple at 200, maybe during a bear market, Apple will be down at 150. So your question is, how do you protect against that? You brought up two ways you can do that, but there's actually three. One is credit spreads, two is buying puts to hedge, and three is selling covered calls. So there's differences in each one. If you sell a put, if you buy a put to hedge your position, in my opinion, when you would do that is when you're very confident it's going to go down, and it's going to go down very violently or strongly, whatever, for lack of better words, right? If you know for a fact, it's going to break down, not for a fact, but you have a high confidence it's going to break down, your position is going to lose value, then it might be worth considering buying puts, right? Because you're going to profit off of the puts. And obviously, if you're buying puts to hedge your position on a long-term account, you're not going for near dated puts. You're looking for, 2 months, 3 months out, because you don't want to be impacted so much by the theta and the volatility. Because again, if you're buying puts during a bear market, you would want to theoretically have time So anytime there's a short cover, a short squeeze, or a bounce, or dead cat bounce, you don't want your contract losing too much value. So I would personally get longer dated options and make sure they're not too far of the money. Because if you have the options too far of the money, in my experience, they lose value very quickly. So the thing is, you have to put up more money to buy closer to in the money or in the money puts. So in the money puts are safer, at the money puts are safe but a little bit risk, and then a little bit out of the money is risky, and then way out of the money puts, even longer dated, are going to be riskier. I personally find the sweet spot in finding at the money and in the money puts. You can also buy deep in the money puts, but that's like if you really think like it's going to go down a lot, because you want the profits from the puts that you bought to outweigh not all, but some of the losses you get in your with your current unrealized losses, right? So when you do a credit spread, you do a credit spread if you don't want to face IV, and you just don't want to sell covered calls. So if you don't, let's say, have 100 shares, then you can't theoretically sell covered calls. So you would sell call credit spreads, and the premium you receive off of that will actually do a pretty decent job, even if the stock doesn't go down too much. So that's another great way. Also, if you want to do covered calls, you already have to have a lot of shares. So covered calls are really great in environments where you think at least you'll be break even or really bearish. But covered calls, the thing you have to realize is it's not really the greatest thing during bear markets, and that's really surprising for me to say, but it's just the truth. Because here's the thing with covered calls. Covered calls really work if you're selling calls above your average fill price. So if your average fill price, and if you guys don't know covered calls, don't pay too much attention to this. You could watch with the wheel strategy, and we'll get into the other questions in a little bit. But if you sell covered calls, if you buy, for example, if you have 400 shares of Apple and you have a fill average price of 150, if Apple's at, let's say, 160, you can sell covered calls anywhere, above 160, 150, because it's above your average price, right? But if you're in a bear market, and let's say Apple goes from 150 all the way, it's down at like 120, you would have to sell covered calls to make a profit. You would have to sell them like actually way too close to where the current price is. And if there's a reversal and that call gets hit, like that call goes in the money, you're going to be selling your shares at a loss if you're not going to manage it before expiration. So covered calls works okay if you have really great fill prices. If you don't have fill great prices, I personally have found that hedging it with longer dated puts that are in the money or closer to at the money have served me better. So I think that's a good answer based on my opinion. So there you go. So for example, a certain level on a 1 hour time frame in a bearish market is more accurate than a level for the same ticker on a 1 hour time frame on a bullish market. No, that's not true. All I'm saying is, okay, in a bull market, let's say you had two levels you're looking at, one at the 5 minute, one at the 1 hour. The 1 hour will still always hold significant value. But, in a bull market, that 5 minute level that you have still has a very high possibility for it working, because that's just how bull markets work. I could go into the explicit details why, but I don't want to run into too much time. Versus a bear market, the 1 hour time frame will have a lot more significance over the 5 minute level, and the 5 minute level has a bigger chance of it being invalidated versus a 1 hour level, right? So yeah. Isn't SQQQ triple short QQQ? Yes, it is, and it is very risky because of that. So I'll get into the chart in just a little bit and the options just a little bit. I just want to get through the questions here. Yeah, thank you, Tom. So FVG just equals imbalance, and imbalance is a term that's used before. So thank you for bringing out the term because I forgot it. Imbalance is what you really want to look at. And FVG, the reason why I hate saying it is because when you mention FVG, you don't think of 1 hour time frames and 4 hour time frames. The knuckleheads will use FVGs, and if you use it right now, I'm so sorry, but that's just the truth. So if you use FVGs in a smaller time frame, if you use FVGs, you're using it on a smaller time frame, right? So maybe what you want to do is you maybe want to shift to looking at stuff that are on the bigger time frames, because those will start holding a lot more importance. So yeah, again, if I'm sounding rude, is because I've seen this happen, and it sucks about the amount of misinformation that's out there. So that's why, like, I'm saying it, because I don't want what happened during pandemic, even though it's gonna happen. It sucks to know that's gonna happen again with a lot of people. I gotta get her off of Robinhood. I got PDT and can't reverse it. Can only trade cash account, so no more level 3 options. Yeah, of course, man. But so here's something you didn't really ask, but something you brought up, is the importance of trading platforms during a bear market. So this wasn't a problem many years ago because Robinhood wasn't so big of a thing. But obviously after the pandemic crash, it became very big. Way big. Way bigger than it was before. And here's the thing. Yes, Robinhood has made some improvements. And one thing I will advocate for, not advocate, but what I will give Robinhood is for trading credit spreads that are longer dated. Robinhood, I can't really say anything against it. It does okay at its job. But if you're swinging and day trading, all I will ask you if you're going to try to use Robinhood during a bear market is if you're having trouble filling on your day trades and swing trades at specific points and suddenly when you want it, and if you're not getting the greatest fill, consider that, but 2 times worse during a bear market, because the moves are much more volatile. And if you are a person who uses market orders right now, best believe it's going to be giving you even worse fills during the bear market because the volatility is going to be increased. So let's say you're in puts and you're up like 60% and you try to market order sell it, and you're on Robinhood and you're in a bear market, you try to market order at 60%. Let's say in a fraction of a few seconds there's just a short squeeze that happens. It doesn't even need to even be a big one. Just 20-30 cents up on QQQ or 10 points up on NASDAQ, that will literally cause you to get a fill and not 60% profit, but at, like, I've seen this, and I'm not kidding, during the pandemic crash, people get filled at 20% and 30% profit because the bid and ask, even for ETFs, go pretty wide in a fraction of a second, and then they go back to normal. So consider that. Maybe it's better looking at alternative options. If you're not day trading, if you're not swing trading, completely ignore me. Do you? But that's just something to consider. Well, if I think it can drop that much, isn't it better to close it? Yes, absolutely. If you think it's going to drop a lot, absolutely. The only reason you would theoretically keep onto a long-term position that you feel is going to drop a lot is if you really believe, for some reason, that it's going to rebound and you cannot predict when it's going to rebound. So, for example, let me give you my personal example. Baba, let's say we go into a market, bearish market tomorrow. Let's say Baba, I got an amazing full price at $80. That was one of my worst fills, right? Let's say bear market tomorrow, today Baba was at what, like 130? Let's say Baba goes down all the way to $60. I personally will not want to get rid of Baba because I know how undervalued it is in the bull market. It was undervalued in the bull market, and the fundamentals behind it tie up. And I love Baba. I mean, I've been having this trade. The two short squeezes that's happened in the span of the past 6 months have been extremely profitable for my long term. I love Baba. That's just me. I have an attachment with Baba. Not afraid to admit it. So in that case, that's when I would not want to sell my Baba shares, because maybe I won't be able to predict when the reversal for Baba to the upside is going to happen. So then maybe what I would want to do is I'll think, hey, you know what? Let me risk some of my capital to buy a in-the-money put or close to being in-the-money put with a high delta, and I will risk that capital to at least protect some downside. And that's when I'll use a put. But if I'm like, let's say I have Roku long-term shares right now, I'm not connected to that position. If it goes down, I'm completely fine with selling it. I'm already made a decent profit off of it, So yeah, exactly. So there you have to, it's no like concrete answer. It really depends on what you think of the position you have. Do you have a delta you prefer for credit spreads? The rule of thumb is if you're going like, let's say 30 days out, usually the safer deltas are around 30. So, if you're looking at options that have 30 delta, that's usually considered safer, because if you were to look at delta, it kind of gives you theoretically a % chance those contracts will go in the money. If you guys don't know credit spreads, please watch our credit spreads video. But if your delta is 30, then you're technically, the option chain is saying that, hey, by expiration, there's 30% chance your contracts will end up in the money. So that means you have 70% chance to end up profitable. So the lower the delta, the better. Usually 30 is the sweet spot. The lower you go, the less premium you receive, but the quote unquote safer it is. The higher delta you go, the more premium you will receive. So if you go for like 50 delta, you will be receiving more premium. And if you want to get into those trades, you also want to make sure it's before 21 DTE, days to expiration, because if a credit spread reaches 21 days to expiration and your credit spread is in the money, there's a significant chance that you will be exercised. And if you're exercised, you're going to be hitting your max loss on that credit spread. So if you're trying to take in the money credit spreads and you believe a strong movement's going to happen or close to in the money credit spreads, you want to make sure that you have your timing and your entry pretty precise, and you maybe want to get longer dated because you don't want to get into a position where your credit spread is in the money and you end up hitting max loss because those contracts get exercised. Wow, exercised. Give me a second. Let me drink some water. Okay, here's a good question. For long-term account, we have Serve and Mara in red. Could you use them as an example of how you can use option strategies to make it out of the situation? What I'm going to answer and the way I'm going to answer, unfortunately, is not going to be a great answer. Mara and Serve are not positions I am attached to or I find too much value in, because the reason I got into Serve was because it's a great robotics company and it's a very high risk trade because it recently IPO'd. When it comes to Mara, the only reason I have that stock is because it has very juicy premiums and I love selling covered calls on them. So if I have a stock that I use primarily for covered calls, you could already tell that if we're in a bear market and Mara is going down even more, the covered calls are not going to do anything. So realistically, what's going to happen here, if Nvidia doesn't beat, or let's say Serve and Mara just break the points that I don't like, I have to accept the losses on them. That's just unfortunately it. That's just the truth. Yes, of course I can buy a put and I could try holding it. But you have to also realize that Serve and Mara are very risky stocks. They have high volatility already in a bull market. So imagine the IV they will have in a bear market. It's going to be double, if not triple. So I personally don't see me getting into options for it. I'd just rather accept the losses and move on to something that's safer. You're making a switch. Would you recommend Webull or TOS? I'm using TradingView for now and charts. I like that a lot. First of all, TradingView for charts, I personally love Thinkorswim, but TradingView for charts I have nothing against. You can literally find a lot. TradingView charts are fine. Thinkorswim provides the greatest tools that could benefit your charting experience and scanners, but TradingView is perfectly fine for the average trader, in my opinion. Now, when it comes to what's it called? Platforms, I'll list out to you my personal opinion on what I think the best platforms are. So I'll rank it from worst to best. And again, these are my opinions. So worst is Robinhood, so I'm not even going to put that on there. Second worst is Webull. Yes, that's surprising, but that's the truth. Actually, you know what? Just because I want to be a dick, I'm going to put in Robinhood. Wow, I can't. Right there. Webull is second. And then after Webull, actually, it's... Oh, sorry. Hold on. Webull is actually not second worst. Moomoo is. But I will tell you this. If people are using Moomoo here and their option fill have gone better, then you can, if you are, I'm surprised you guys don't know Moomoo. Those advertisements are everywhere. It's a Chinese trading option trading platform. They do really great advertisements. Yes, they do got Hulu commercials, but there's even another crazy one. I'm going off task, but there's even another crazy one that offers option rebates. I was like, what? So anything that seems too good to be true, just maybe you might not want to consider it. So Moomoo second worst, Webull is third worst, and that might be surprising. The reason is because the reason why Webull seems a good option to a lot of people is because they compare it to Robinhood. But once you get out of this league of shitty platforms, and there's quite a few more, but they're like lesser known, they're more subjective to certain people if they use it. Let me just write Robinhood so people could see how clearly I hate it. All right, the better platforms, I'm gonna list them out. So IBKR, Interactive Broker. One great thing about this is the fact that a lot of other countries can actually use it. So it's not just restricted to America. I don't know the specific countries. I think Canada is able to use it, so on and so forth. Have really great fill times. Fidelity, really great as well. Decent fill times, really great for long term. If you're swing trading, it's a really great swing term. Swing. Wow, I'm stuttering. Swing. Trading platform. The next one is, I would have to tie these two together. It would be E-Trade and Tasty Trades. I think it's Tasty Trades or Tasty Works. I think it's Tasty Trades now. They changed their name. These two are amazing. E-Trade is amazing for day trades and swings. I actually think it's a little bit better in scalping and day trading versus swing trading. So this is like if you're, predominantly day trading or scalping. Like for example, JP uses E-Trade and he finds E-Trade Pro, and he finds a lot of success in it. It fits his needs. Versus Tasty Trades gives phenomenal fill times. And it's run by Tony Sazanoff, or whatever his name is. And if you guys don't know who he is, the reason why I'm mentioning his name is he was actually the co-founder of Thinkorswim. So he was able to, and I misspelled his name over here, so I'm so sorry, but he actually was able to build a really great platform. And Tony Sosnoff, I think that's his name, pretty sure that's his name, he built Tasty Trades for credit, or not really credit spreads, but spread or complex trading strategies. So it's really great. I mean, Tasty Trades is less for day trading. You can still day trade on, but it's less for day trading. It's more for swing trading, and especially complex option strategies. And the great thing, here's the thing, when you get into this league of superior trading platforms, you will face commissions. That's just a reality. But I've said this multiple times before. Just because something is cheap does not mean it's great. And just because something is expensive does not mean it's great either. But if things have a price tag and you have the information to validate its quality, it's worth sometimes that sacrifice, at least in my opinion. So these, you will face commission. That is just a fact. But a great thing about Tasty Trades, if you don't like facing commissions and you have a big portfolio, I think this is still the case. I'm pretty sure it is. Tasty Trades caps their commission at $10 for a single trade. So my commissions are pretty high because I use Thinkorswim, but I have the lowest bracket for Thinkorswim. But it's still like I'm still facing commissions, right? I'm considering moving some of my portfolio towards Tasty Trades. I'm going to still use Thinkorswim for swings and for day trades, but I'm going to use the capital I put into Tasty Trades for complex strategies such as credit spreads, iron condors, and stuff like that, because the commissions I face on Thinkorswim are not high, but they're still commissions. So at least on here, on Tasty Trades, my commission is capped off at $10. So that's a huge benefit if you trade those kind of strategies. And of course, Thinkorswim is just the best for multiple reasons. I don't know why I run either. It has the best fill times. I'm not sponsored by them. Best fill times. Best tools. It literally has this platform has the best tools in the entire market. The tools that you find on Thinkorswim are tools you would have to search on other websites when you have any other platform. It's just so superior. The things you have on Thinkorswim on the desktop app is just amazing. It is the best desktop application you could get, and I've used almost all of these applications. And by the way, if you're a person who does not want to deal with the desktop version and you think it's too complicated, their mobile version is actually very easy to understand. I think it is the best mobile app you can have for day trading, because you can actually look at charts. It's pretty easy to look at charts. The option chain is easy to read. You can easily see your positions. You can easily see the news that's coming up, upcoming earnings. The fill times are great since you're still using the Thinkorswim platform. So, like, for example, Webull, I'm not going to shit on their desktop because at least it's okay. But it's still, like, it's not as great. Like, their mobile version is better than their desktop version. The only reason is because their mobile option offers so less. So Thinkorswim personally is my go-to. It always will be. Even if I'm moving money to what's it called? Tastyworks or Tasty Trades, whatever it's called. I'm still going to stick majority with Thinkorswim, but I will be honest with you, your start off commission will be high. Your start off commission is 65 cents to enter a trade, and then 65 cents to exit. This is per contract. So per contract, you are looking at a total of $1.30 commission per contract. So what that does is, if you're in a small account and you're trading cheaper options, it might be a stickler, $1.30. But then my answer to you, if you're like, hey, what if I trade small options? Why are you chasing after small trades? If you're not chasing, but if you're going after bigger trades and setups, then commissions, in my experience, have not been such a huge factor that undermines my profits. Right, that was a very long answer to that, so I'm so sorry. Let's see. I answered this. No, I didn't show the chart yet. I'm still getting to that. Dude, just call them. I mean, I guess you called them and they didn't let you do it. You hate its UI. I used to use it, but I just don't know. You know what? I'll actually do a live session one day where I'll literally showcase all of the most important tools on the desktop and the mobile version, and that should hopefully help you out. I'll make it simple too. The desktop it doesn't look supremely outdated, but it just looks outdated compared to, let's say, Robinhood and Webull. Because Robinhood and Webull is all like flashy, colorful, and minimalistic. So yes, I will say that it looks a little bit outdated, but I'm so sorry to say this, JP, but at least it's not as outdated as E-Trade. So
E-Trade is great.
Since we're talking about credit spreads, the XPS ones, I know it's a high win rate, but doesn't. Yeah, so if you're trading SPX, XPX credit spreads, or any credit spreads in general, if you're going with a lower delta, so basically if you're going with less riskier credit spreads, the whole strategy is you're basically betting on the fact that you have a high win rate strategy if you're trading SPX or any other stock when it comes to credit spreads, and your winners, even though your one loser will be big, your winners should outweigh the losers that you've had. That's the whole thought process behind it. It's worked for... Sorry, I'm hiccuping because I need water, but it's worked for me. So the few losses that I've had, they don't wipe out all of my gains. They definitely don't. But let's say on an account I made $5,000 on, let's just say, SPX credit spreads over the course of 2 months. Maybe if I have 2 losses from the $5,000 of profits I had, my profits might be just like 2,400 after that, which is still profit. So if you do it on a larger scale and if you do it consistently and you just find the better entries, that is still theoretically good income you have on the side. Because again, credit spreads are viewed as income, right? So that's the whole thing. If you want better risk to reward, then you have to kind of go in the money or close to in the money. But then again, the chances of that working out is less. So you would have to be very confident in your sentiment. Yeah, massive beat on. It has to have a massive beat on earnings. If you guys remember two Nvidia earnings ago, the Nvidia earnings came out not subpar. They came out great. Or even it was last Nvidia earnings. Was it last Nvidia earnings, JP? When it
Yeah.
Yeah, last Nvidia earnings they came out great, but the price opened up at break even the next day, so back to compared to the previous day close, and just Nvidia died off afterwards. So it just comes to show you that the expectations are actually really high for Nvidia, which again I don't like. It's not healthy for the market. But yeah, what's Mubu? Oh yeah, Mumu merch is fire. I didn't even know they had Mumu merch. I mean, Mumu's logo is like orange or something, so I'm not surprised. Ads are everywhere. Yeah, I see it on YouTube. I think I saw it on Hulu before. APY 8%. Yo, if anything's offering high APY, you might want to take a step back. Robinhood kind of offers that. They're okay compared to Mumu. Mumu offering 8% APY.
Rug pull.
Yeah, could be. Yeah. I'm not. I don't know Mumu's platform too much. All I know is that the fill times are not the greatest and stuff like that. Features lack. So I'm not gonna go too much ahead and give any confident take on that. But yeah, yo, Fidelity account. Yeah, Fidelity is great for long term and swings. Oh my god, I did not know they had this stuff like this. What the hell? Where are those points from? What, like trading with them or something? You trade and you get like certain points. That would be crazy. That glad was interesting. But I heard. Sorry, I'm just reading through your questions. JP, there's a question for you. What's the difference between E-Trade and E-Trade Pro?
E-Trade Pro is what you would call their professional trading software. It's the close. It looks more like a Bloomberg terminal than anything.
Oh, yeah.
Yeah, the E-Trade. I mean,
I
let me
actually have a
just do
good way
something.
of answering this. For
I
example,
mean, I can stream it right now. If you give me 1 second, I just want to make sure I don't have certain things.
a good example is how like TD Ameritrade used to own Thinkorswim. TD Ameritrade, you can still trade on TD Ameritrade, which would be E-Trade, but Thinkorswim was their actual trading platform, which is like E-Trade Pro in this sense. So yeah.
But I'm streaming my E-Trade Pro right now,
Okay, let
and
me stream up.
basically this is like my main. There's another box here that needs to be here, but I've minimized it. But this is basically my default page where my positions will be here and my account size is here, and I flip through whatever I want. This is the level twos. This is the time and sales. This is I have an RSS feed that I have certain things that I watch, but here's all the top news that's coming in as fast as possible. This over here is the level twos, um, which you can see pretty much gives you the in-depth of where all the prices of everything is. And then normally this would be running full time at all times. And this thing's going nuts, you know, the bid and the ask, and over here is the time and sales. These are limit orders that are being hit, that are being put into the market. Um, so these are the limit buys, and these are the limit sells, and these are the actual market orders that are coming in. And when we talk about looking for block orders, is you scroll down. Obviously, right now you can't see too much, but you look for big blocks, and big blocks are not 1,000 or 2,000 on an AMD. You look for big blocks are like 10,000, 25,000, and those normally are key levels of support and resistance. And I mean, everything else looks the same, pretty much. Like when you look through this stuff, I mean, this is just like market movers. You have all the sector breakdowns. You can arrange this by high-low tickers. This is like a main screen that use to look at stuff. You know what I mean? Just to kind of gauge where the market is, and this is how I see where sector rotation is happening because I can see where things are moving. Is it moving into basic materials, energy, et cetera, et cetera? And then this breaks everything down by its own individual sector. So if you wanted to go into, let's just say, hypothetically speaking, um, consumer cyclicals, then you can actually go into consumer cyclicals and break down like appliances and tools, and then you can look at every single stock that falls into that subcategory. So this is just very, very in-depth stuff that if you're either trading long term or really kind of trying to gauge the market from a different perspective, um, it's great. A lot of people think it looks kind of weird. I personally don't think it does. A lot of people don't understand how this all operates. This is a talent in itself to read tape. It's not very easy, but once you start to understand where walls are, where block cells are, and what institutional signals are being sent back and forth, it's almost like you don't even need to chart because you can literally just not have this up and you can just trade off reading tape because at that point this is just true price action. This is not even about looking at a chart or RSI or MACD. It's understanding where buyers and sellers. So yeah.
Yeah. Pretty great explanation, JP. Um, that the thing about E-Trade is actually a lot of whales use it too. So, there's that because it has a lot of information. So I'm gonna get through the last few questions. I'm gonna show SPX one, during the pandemic crash, and then we'll kind of call it wraps because it's been 2 hours. Yeah, about. All right. Someone asked.
But actually, Kevin, I
Yeah,
have
what's
to
up?
jet out here because I have to go walk my dog. So I will catch you tomorrow.
Yeah, of course, man. Pleasure having you
All right.
on, dude.
Take,
Thank you.
take care, guys.
Yeah,
Have a
see
good
ya.
one.
So, let me close this. What was I gonna say? Right. So the question was, would you recommend trading on funded accounts during bear markets? First of all, I can't recommend anything. I'm not a financial advisor. Um, I mean, yeah, you could trade it. I mean, I don't really have a concrete opinion on that because it kind of ties into what I said earlier, where yes, prop firms might be around, but they are going to make their rules much more stricter to make sure that they're making profit margins. So if you have a funded account, I mean, if you have a funded account, like a bear market is not going to last a few days or a few weeks. You're looking at something that could last a year to 2 years. It's not something that's short lived. So then the next question is, do I not want to use it because I think we're not in a bear market? Well, okay, if you think you can hold the funded account through a bear market, I mean, what's the chance your prop firm, whichever prop firm you're looking at, is going to be there the next year, right? So, um, a lot of companies, trading related and not trading related, during 2007, during 2018, during 2020, during the pandemic crash, a lot of these companies just went away, just any company. And so it really, it's, I can't really answer that question. I'm sorry. I wish I could, but I can't. So we got a few other questions. I answered that. POT has some puts holding night. Is a strong bounce possible? I mean, I'm bearish on pound here, so I can't really unfortunately ask you that. I'm not sure what's going to happen. First, you're trading on how this, for example, yeah, I'll show that. Are we hinting that bear market coming, or is it here already? This is a good question. What I'm saying today does not mean you go in tomorrow just looking for puts because you think that a bear market's going to happen. We have the reason why I start off the way I start off this whole presentation. And if you join late, that's fine. I'm going to upload the recording tomorrow morning. And by the way, when I do, please, it means a lot when you guys like the video and subscribe because it does actually support us here. But this does not mean we're going to start a bear market tomorrow. And the reason I start off the session the way I did was one of the first things I said is it really determines on how Nvidia earnings is. And it sucks to say that, but it's just true. If Nvidia beats earnings, we are going to see the market postpone its bearish, its bearish bear market, right? Sorry, I'm scrolling up here, so I kind of lost my train of thought. So it's just going to be postponed. So let's say Nvidia does beat earnings. I thought I drew it somewhere, but I guess I didn't. Oh yeah, I did. So this is what you probably will see. Like, for example, let me so let's say the market has been strong to this point. Market has been looking like this, right? Let's just say it's been looking like this. And then let's say Nvidia beats earnings. What you'll probably see is something like this, small melt up phase. That's what it's called. And then eventually you start seeing, consolidation, or you might just see a straight drop down. And it's hard to predict when this will be here, when this will happen. It's just the truth. Unfortunately, that's just the way it is. I can't give you, I can't say, I wish I could say it for my sake and your sake. Hey, Thursday, we're going to have a bear market. It's starting right now, starting then. Unfortunately, the only way you could figure out is by waiting for it to happen. And the reason why you had to wait for it is because it's a collective movement. You look at the 2000, there was a really great movie. I forgot what it was. Everyone knows the big, what was it? The Big Short. But there was another movie that came out about trading, and I forgot what it was. And it was, if you guys remember this movie name, please let me know. It was about a movie where it was just these guys working in a bank that had a bunch of mortgage loans, and it was just the whole movie was just them basically in that office building, and they've recently laid off a bunch of people, and this one guy came up with a calculation where the market is gonna cut to the downside. There's gonna be a huge bearish market, and eventually that bank saw that guy's projection. They got so scared that they sold off a bunch of their assets, and they sold to other banks. And then when the other banks realized after the market closed that this first bank sold so much, then they started selling the next day. So it's really hard to predict it, because all it takes is one bank or one move or one news that comes out that just causes it. Does anyone know what that movie name is? By any chance? Margin Call. Wait, no, is it Margin Call? Is that the movie, Joe Bosco? Margin Call? I think it's Margin Call, right? It is Margin Call. Okay, cool. Margin Call, great movie. You guys should watch that, because that shows you it's not a fast-paced movie. It's a good movie though, and it just shows you how there's a huge domino effect, and these things are just hard to predict, because even the bank they didn't really get ahead of anybody. They just sold earlier than the majority of the banks. They weren't ahead of anybody. They didn't predict it. They just saw a possibility and they just acted first, and that caused everything afterwards. So watch that. It's a really great movie, Margin Call. Not as funny and fast-paced as The Big Short. Big Short's a great movie as well. Shows a lot of the things that happened behind the scenes and people who profited. But Margin Call actually shows a really great perspective of how banks acted before and during the crash of 2008 or 2007. Sorry, I keep on mixing the 2 years. All right. I have a TOS account with $100 balance, no monthly fee. I've had it for 20 years. I don't know what the minimum is now. Yeah, I think you just need $50 in your TOS account to have live, undelayed quotes. So even if you just want to use Thinkorswim for the features like its scanner, the rewind feature, which I told you no other platform has, and I will make a video on it because it is so amazing. You could backtest. What platform? And I know I sound like I'm gaslighting them, but you guys know me. I'm so monotone. When do I talk about something so greatly? What platform allows you to go back in time to see price action on any given day, on any given time, and actually see the option chain moving? And then you're actually able to trade that option, and then you could skip forward to the next day. And if you want to see, you would actually see how that option ended up. If you were profitable, if you're not profitable. It's just too good. It's just amazing. I can't say enough good things about it. And I don't advocate for things I don't think are good. Should we consider non-tech plays like staples or energy for bear market? Energy did great in 2022. That's a really great question. It's a tricky question as well. So this ties into actually one of the first things I talked about, and I think this might have to be the last question I answer before I go into SPX, is this ties into what I talked about here in the beginning. Higher beta stocks are going to be impacted the most with a bear market. So that's when you would want to look at lower beta stocks. Oof, my stream has been on for so long. It's glitching out. So lower beta stocks are going to be theoretically safer. But keep in mind, the conflicts we're facing now in foreign affairs are a lot different than what we faced in the pandemic and in 2007. So what that means is, for example, energy may not have been as heavily impacted back then during those crashes in like 2022 compared to right now. Why is energy impacted right now, or a little bit riskier, is because you have everything going on with Iran. The whole Palestine-Israel thing. Palestine is somewhat tied in with Iran. So Iran, obviously, that's going to be tied in with energy. Ukraine, that's going to be tied in with energy as well. So maybe energy, maybe not so. If you see a setup, by all means, I can't say no to it. But you might want to also consider the fact that it is going to be riskier compared to, let's say, companies like Coca-Cola, eBay potentially. I have a whole thesis on eBay. I'll talk about it another time because that's something else. We'll see after earnings. Coca-Cola, Pepsi, PG. We had to see how Walmart, because Walmart is just too overbought. So I actually don't know about Walmart anymore. Walmart, you know, yeah, the list goes on, but there's a lot of safe stocks out there. Yeah. Or not safe stocks, sorry, let me take that back. Lower beta stocks, which means they're less riskier. But okay, I'm gonna show one last thing, and I'm gonna keep it brief. I'm gonna show you the SPX chart of 2020, of whenever the pandemic crash was, because my brain's not thinking straight, and I'm hungry as hell. Sorry for my language. Let me put my tablet aside. By the way, if you guys want to know what beautiful tablet I'm using the S9 Ultra from Samsung. I used to have an iPad. Freaking love this tablet. All right, let's go to SPX. So let me pull up SPX full screen. Bring it over here. All right, let's go. Can I rewind to a certain day? Oh, no, I can't. I had to go all the way back. All right, so when was the pandemic? This was the pandemic. Basically started 2022. Let's go. Let me put a timeline so I can easily make sure I'm on the right thing. Let me go to right here. Oh God. So like Thinkorswim would not give me these issues, but at the same time I'm also not using it completely correctly. So let's see. So I go to 2 hour. All right. If I go to the you could see here. This is the start of the 2022 crash. Even though if you go and zoom out to the daily, you will see. Wait, am I dumb or? No, I'm right, right? Yeah, I'm right. Okay, so. Wait, am I dumb? The pandemic crash started in 2022, right? Oh. Okay. Well, I'm dumb. So if we have two crashes you can look at. You have the 2020 crash. So if we go to 2020, you could see here this sheer amount of selling pressure we had. Hopefully this, bro. All right. Is this 2022, man? Oh my God. You know what? I'm being a dumbass. Let me just do this. There we go. All right, so if we look at this crash, please tell me if I zoom in. All right, there we go. If you look at this crash, you'll see that I'm just looking at a swing period because I'm too tired to look into a day trading perspective. For example, if you got a swing on this day itself, say you got into SPX puts, for example, right? And you have 2 weeks out, this movement right here, this little pop, even though it's so small, that thing would take away 10 to 20% of your profits. I'm not kidding you. So it's just crazy. And you could see here, there's so many setups on SPX that just did not work out in the end. Like, where is it that you can look at this and think, hey, this is predictable market? And this is SPX. If you could look at any other stock and it would be the same thing as well. Yes, of course, once it starts becoming bullish, yes, setups are a little bit more readable, but then again, when it becomes bearish, that's when everything goes out of the door. So these crashes or correction waves are always followed in three. It's the ABC, right? Something we'll go over in the next video. And I'm sounding dumber and dumber because my brain is getting fried. But it's just like, I don't want to get into too much detail, but you could look at it yourself. You'll see, like, on a day trading perspective and a swing trading perspective, it's better to less look at SPX and more individual stocks, and you'll see how all over the place it is. And you'll see a lot of times when it gaps down, you'll actually move into the upside or try to short squeeze into the upside, and that short squeeze to the upside will actually kill off the contracts. But it was a pleasure talking to you guys. If you guys have more questions, I'm sorry. I'm too hungry and I'm tired, so I'm going to end it here. It was really great talking to you guys. I want to stress how important today's live session was. Again, this is not me saying that the bear market is going to start tomorrow, but this is me saying that it's very important to at least consider the fact that it's a possibility soon. And I think on Thursday, we're going to do a risk management session. I have to see. I mean, this took a lot of work to do just today. So I don't know if I'll be able to do something as big as risk management on Thursday, but if I do, of course, I'll let you guys know. But please, when this posts out, if you were here the whole way, appreciate you guys being here for the entire time. Just leave a like on the video. Helps out. I'll post it tomorrow morning. All right. Appreciate you guys. Have a nice night. Hopefully AMD puts work out. If it doesn't, I don't know what to tell you. All right. I'll see you guys later. Peace.